Hello, dear connection. Welcome once again back to the Center for Distance and Online Learning of Integral University, Lucknow. I, Dr. Jamal Abdul Nasir Ansari, working as the assistant professor in the Department of Commerce, Integral University, Lucknow. Today, we'll be having a very informative and very impactful lecture presentation on the topic valuation under the goods and service tax. If you remember well, in our previous classes, in our previous lectures, in our previous videos, we had the concept of goods and service tax, and we similarly followed by lecture 2, we had the lecture, we had the presentation, we had the video on how the goods of service tax means what are different mechanism under the goods and service tax. We had studied very well in our previous classes. Yeah, in the previous lecture, in lecture 2, we had to discuss about what about the basic of goods and service tax. For example, supply of goods and service tax, time of supply, place of supply, and similarly, we have also discussed the concept of value. Composite supply and mixed supply means necessary, informative, and very impactful things we had discussed in our previous classes. So I hope that you have enjoyed, the audience have enjoyed very well in respect of getting the concept of goods and service tax. So in these lecture, in this video, we will be having the concept, going to study the mechanism of valuation under the goods and service tax. So let me brief that what we are going to study in these lectures. We will be going to study a very informative, very important aspect of Goods and Service Tax Act, means how goods and services are valued, at what price the services as well as the goods are valued. So in this lecture we will be going to study a very thorough discussion on how the goods are valued under Goods and Service Tax Act, means as per the doctrine, as per the guidelines laid down for the valuation of goods and services as per the Central Goods of Service Tax Act 2017. We will be discussing in this video. We will be going to study the concept of input tax credit. We will be going to study the concept of TDS, tax reduction at source, tax collection at source, and many more important aspects of goods and service tax we will be studying in this video, in this presentation. So now it's time to start the presentation. I hope that you are eagerly waiting for just to get the concept clear. So we will be here just to address all kinds of necessary confusion, conflicts, or anything else which you want to. So in this lecture you will find, and I'm sure that this lecture is going to be very informative, right, from a knowledge perspective, from practical perspective, because we will going to start a very important aspect of Goods and Service Act, which is known as the input tax credit, as well as the valuation under the Goods and Service Tax, means how the goods are valued and what are the rules, and what about the rules and regulation in respect of the valuation of goods and service tax has been laid down in the Central Goods and Service Tax Act by the CBIC, Central Board of Indirect Taxes, which is the department working under the Department of Revenue, under the Ministry of Finance, under the Government of India. So we will be studying the concept of the valuation of goods and service tax. So without further delay, let me introduce the concept of valuation under the goods and service tax. So there are there are different and fundamental doctrine has been laid down in respect of the valuation of goods. The method and the rules have been prescribed, means based on that rules, based on that method, necessary goods as well as necessary services are valued. So GST is a tax payable on ad valorem basis, means percentage of the value of the supply of goods or services. Section 15 of Central Goods and Service Tax Act laid down and determination of the value of supply of central sales goods, central Goods and Service Tax Rule 2017 contained the provision related to the valuation of supply of goods, supply of goods or services made in different circumstances and to the different person. So the section 15 consists the valuation method as well as the rules, means how the value of the supply are going to be determined under Central Goods and Service Tax Act 2017, means as per the rules of 2017. So the first rule is where the supply of goods or services is for the consideration not only in money. The value of supply shall be, suppose if a supplier supply necessary goods or services to the recipient of the goods, and that goods or services is for consideration not wholly in money, means not means some part of these goods and services is part of money and some part is what for the consideration. So in this case the rule first say that be the open market value of such supply. If the open market value is not available, so be the sum of the total consideration in money and any such further amount in the money as is equivalent to the consideration, not in money, if such amount is known at the time of the supply. So the first rule in respect of valuation of goods and services means method and the rules. First is rule where the supply of the goods or services is for consideration and that consideration not only in money. So the value of the supply, the value of such goods and such services will be the open market value of such supply. And if the value open market value of such supply is not available and that time the total consideration in money and any such further amount in money as equivalent to the consideration not in money. So if such amount is known at the time of the supply, so it will be the open market value of such supply. Further, if the value of supply is not determinable under clause A or clause B, as we had just right now discussed, so in this case, the value of the supply of goods or services are both of like kind goods and quality. And if further point third mentioned, the rule third say if the value is not determinable under clause A or clause B or clause C, so be the sum of total consideration in money. So the value of the supply will be the total sum of consideration in money. What is consideration? Something for something, means once a supplier supply goods to the recipient of that goods or services. So for the same purposes, the recipient going to receive the goods or the services as the case may be. So the recipient will pay for the that goods or services. Consideration means something for something. You have supplier have supplied goods, recipient have make the payment in cash or in kind. So that is known as a consideration. So the value of the supply, if clause 1, clause B, clause C is silent, then the the sum total of the consideration in money will be the value of the supply. With the help of example, we can understand the concept of the valuation method and rule what we had just right now discussed in our previous slide. First example is new phone is supplied for 20,000 along with the exchange of an old phone, and if the price of the new phone without exchange is 24,000, The open market value of the new phone is 24,000. Once again, try to understand when a supplier supplied a smartphone for 20,000 along with the exchange of an old phone, and if the price of the new phone without exchange is 24,000, in this case the value of the supply of such good will be 24,000 as per the CGST Act, CGST Rule 2017 under section 15 what it has been laid down. I hope that the example is clear. Now take the second examples. What I just right now we have told you, where a laptop is supplied for 40,000 along with a barter of the printer that is manufactured by the recipient, and the value of the printer known at the time of the supply of that goods is rupees 4,000, but the open market value of the laptop is not known. So in this case, the value of the supply of the laptop will be 44,000. 4,000 is for the exchange of barter, exchange of the printer that is manufactured by the recipient of the goods. Supplier A, here one of the party supplier A, supply the goods, means the goods, the name of the goods is mentioned here is the laptop for 40,000 rupees to the Y. So X is the what, supplier, Y is the what, known as the recipient of that goods. So X have supplied a laptop means goods of amounted to rupees 40,000 to the Y, and with the exchange of the printer, and that printer is manufactured by the Y, means the recipient of the goods, and the value of the printer is known at the time of the supply is 4,000, but the open market value of the laptop is not known. So in that case the value of the supply of such product will be 44,000 rupees. As so I hope that by way of these two examples, the rules for the valuation of goods as per section 15, the methods and the rule is now clear with the help of examples. Moving ahead in this direction, point number 2, rule number 2, next rule is mentioned the value of the supply of goods or services or both between distinct or related person other than through an agent. So in this case, the value of the supply of goods or services or both between distinct person as specified in subsection 4 and 5 of section 25, or where the supplier and the recipient are related other than where the supply is made through an agent. So in this case the value of that goods or services will be, first point, be the open market or be the open market value of the supply. First point, if the value of the supply will be out of these three, first the open market value of the supply. Second, if open market value is not available, so will be the value of supply of goods or services of like kind and quality. And third point, if the value is not determinable under clause A or B, what we have just right now said, at that time the value as determined by the application of rule 4 or rule 5 in that order. So if the value of the open market is not available, right, and if not available, so similar kinds of goods and the quality will be the value of the supply. And if out of this nothing is available, so at that case the rule 4 or rule 5 will be applicable for the value of the supply. Now the third rule moving in this direction said that the value of the supply of goods made or received through an agent. We can see that nowadays in the practical life, number of goods and services are supplied not by the company but through an agent. So in this case, the value of the supply will be the value of the supply of goods between principal and his agent shall be open market value of that goods being supplied, or or at the option of the supplier, means 90% of the price charged for the supply of goods of like kinds and quality by the recipient to his customer, not being a related person. So where the goods are intended for further supply by the said recipient. So in if a goods is supplied by an agent, in this case the value of the supply of the goods will be open market value, or at the option of the suppliers it will be the value of the supply. For example, for instance, we can take the example where a principal supply groundnut to his agent, means X is the what the principal means the supplier, and Y is the agent working on the behalf of the principal means X. The agent is supplying groundnut of the like kind and quality in subsequent supplies at price of 5,000 per quintal on the day of the supply. Another independent supplier is supplying Another independent supplier is supplying the groundnut of like kind and quality to the said agent at the price of 4,550 per quintal. The value of the supply made by the principal shall be 4,550 per quintal, or where he exercised the option the value shall be 90% of 5,000, means 4,500 per quintal. I hope that you are getting my point. If not, let me make it in more simplified way. There are two suppliers of groundnut A and B. A supply groundnuts to the agent at the price of 5,000 per quintal, and the same like kind and quality. Another independent supplier is supplying the same kinds of groundnut to the agent, which is known as C here in our case, at the price of 4,550 per quintal. So in this case, the value of the supply made by the principal shall be 4,450. Why? Because the value of the principals made by 4,550 per quintal, or where he exercised the option of the value shall be the 90% of 5,000, means 4,500 per quintal. So it will be the value of the supply of groundnuts. Here two suppliers are there, A and B, and C is the working as the agent. A supply the groundnut of the like kind and quality in subsequent supply at the price of 5,000 per quintal on the day of the supply, and another is what supplied for 4,500. So in this case, the value of the supply made by the principal shall be 4,550 per quintal. Moving ahead in this direction, where the value of the supply of goods or services are both, means goods as well as services, both on cost. So the rule is said where the value of the supply of goods or services or both is not determinable by any of the preceding rules. So the value of such goods or services shall be 110% of goods of production or manufacture, or cost of acquisition of such goods or cost of provision of such services. Means 110% of the cost of the production will be the value of the goods and services. So value of the supply of services in case of a pure agent. As just right now we had discussed the concept of the value of the supply of goods. Meanwhile, in the practical life, in the practical world, both goods both goods as services are too supplied. So in case of a services, what the rule said, as if in case of the pure agent. So anything contained in this rule, the expenditure or the cost expenditure by the supplier as a pure agent of the recipient of supply of services shall be excluded from the value of supply. And if all the following conditions are satisfied, which are first, the supplier act as a pure agent of the recipient of the supply when he makes the payment to the third party for the services. Rule number two, the recipient of supply uses the services so procured by the supplier services provided in his capacity as a pure agent of the recipient of the supply. And the third point, the recipient of the supply is liable to make the payment to the third party. And the fourth rule is the recipient of the supply authorizes the supplier to make the payment on his behalf. The fifth rule, the fifth condition is the recipient of the such supply knows that the services for which payment has been made by the supplier shall be provided by the third party. Rule condition number 6, the payment made by the supplier on behalf of the recipient of the supply shall be separately indicated in the invoice issued by the supplier to the recipient of the services. Condition number 7 got laid down. The supplier recovers from the recipient of supply only such amount as has been paid by him to the third party. And last rule number 8, condition number 8 said the services produced procured by the supplier from third party as a pure agent of the recipient of supply or in addition to the supply he provides on his own accounts. So out of these, the will be the value of the supply. So I hope that you got the points regarding the value of supply. So what we have discussed is all about in respect of the valuation of the supply. In the coming next slide, we will be having the help of example. We will be going to understand more and more informative concept in respect of valuation of the supply. It is not yet clear. It is not yet done. We will be having more and more, discussion on the said topic. So now the next discussion is the what taxability of the reimbursement of expenses. So here Goods and Service Tax Act and rules clearly have laid down the guidelines with how the reimbursement of the expenses are taxability. Section 7 subsection 1 of Central Goods of Service Tax Act said reimbursement is supply or not. Further, Section 17 said the value of the supply as we had discussed previously. Rule 33 of Central Goods and Services Tax Rule value of the supply of services in case of the pure agent we had discussed. How to show in GSTR and Section 2 subsection 47 of Central Goods and Service Tax said regarding exempted supply and section 2 subsection 78 of the non-taxable supply of goods or services. So by way of following all this thing, we will going to find out the taxability of a reimbursement of expenses. So I hope that things are now clear. Now the very important aspect of goods and service tax we are going to start right? Which is nowadays in the practical life, most of the businessman, most of the trader, most of the service provider are day to day getting handling these kinds of things, which is the topic of these discussion is the what input tax credit. So we will be going to study a very thorough study in respect of input tax credit. What is the meaning of the input tax credit? How the concept came into existence, and what the rules and regulation in respect of input tax credit of central goods and service tax is laid down. Means how this is going to calculate it, right? Input tax credit and what is the meaning of input tax credit? We are going to study. So now try to understand first its meaning, that what is input tax credit, and later on we will with the help of example we will going to study how, what about its treatment, means how it is going to get credit, means what is output tax, what is input tax credit, and why this concept came into existence, and what is the CGST Act 2017 laid down the guideline in respect of ITC. So, from the meaning point of view, ITC is the goods and service tax paid or payable by a registered person on the purchase or expenses incurred for the business activities. Most of the human needs are satisfied by way of two things, as I have quoted earlier. First one is the word goods, means products. Second one is the services. So, in order to manufacture a goods, take the example of garment industry, take the examples of automobile industry, four-wheeler industry, the various raw materials of the car, the various part of the car, right, which has been acquired from different places. So at the time of acquisitions, there are number of expenses incurred, number of types of raw material purchase. So on that purchase, the registered person already paid taxes. So in order to avoid, right, cascading effect, means tax on tax, the central goods service tax have given a detailed guideline that how to avoid cascading effect, means tax on tax. So for the same, they have given one of the concept, one of the phenomena which is known as the input tax credit. So in GST, ITC stands for the input tax credit. It is the core mechanism that allows businesses to reduce their tax liability by claiming credit for goods and services tax (GST) already paid on the purchase, means input services or capital goods used in the courses or furtherance of their business, means in order to produce a final product, a finished product, on the acquisition of the raw materials, tax has already been paid on such kinds of raw materials. So in order to avoid tax on tax, the concept of input tax credit has introduced. So with the help of example, we will be going to understand, right, how input tax credit system work. Suppose a manufacturer paid, right, different taxes on at the acquisition of various kinds of goods. For example, here, as per the given picture, input A, B, C. In order to make it final products, tax already paid on the purchase of input A, rupees 100. At the time of acquisition of input, tax paid on the purchase of B, rupees 120. On the acquisition of product C, tax paid rupees on C, rupees 80. So the manufacturer have already paid taxes on the acquisition of A, B, C. It is the what input. In order to make output, input have a tax has already been paid on various types of input A, B, C, which is 100, 120 and 80. So finally the manufacturer have paid how much? 100 plus 120 plus 120 plus 80 means total manufacturer have paid 300 rupees. So it is known as the input tax. And by way of selling, the final after the processing, the inputs have converted after the processing output, and the burden of goods and service tax is laid on the soldier of the consumer final. So the consumer have purchased the products and paid 450 tax on output. So input, I hope that clear, and tax on output, which is 450. So on the same products, manufacturers have already paid the tax, which is in this case 300. So final input, your tax to be paid by the manufacturer 450 less the tax already been paid on inputs means 300. So final tax liabilities of the manufacturer will be in this case 150, not 450. Means in simple word we can say once again that the tax which has already been paid is going to subtract from the output tax. So I hope that the concept of input tax credit is now clear. With the help of this example, you can go for further studies. You will understand the concept of input tax rate, which have a very impact significance in the goods and service tax, because most of the businesses services provider daily working on the same concept, and in every month have to file their the businesses the services, the serviceman, the businessman have to file their GSTR 1, 2, 3, 4, or as per the case may be. So I hope that the concept of input tax credit is now clear. Moving ahead in this directions, so there are different types of input. First, credit in respect of inputs, credit in respect of services, credit in respect of capital goods. Services, I have told you, tax on goods, tax on services. There are a number of services: telecommunicating services, transport services, banking services, insurance services, and that is number of services are available: airways services, railway services, transport services. Means a lot of services are there. Even though educational services too, right? As well as similarly there are various goods, tax on goods. So credit in respect of input, credit in respect of input services, credit in respect of capital goods. So these are the three broad categorization of input tax. What is meaning of input? I already told you, input goods bought for producing finished goods. As just like I told you, in order to make the goods as finished goods, for example the parle ji. So at the time of acquisition of the raw materials, means sugar, right, flour and many more, tax has already been paid on such goods, right? So output tax will be get from the customer on finished goods. So what you have already paid, it is going to subtract from the output tax, to the final will be the known as the input tax credit. So moving ahead in this direction, capital goods are just right now mentioned here. So what is the capital goods? Means assets such as building, machinery, equipment, vehicles, tool that an organization uses to produce goods or services is known as the capital goods. So capital goods, regarding in respect of the capital goods, ITC input tax credit is allowed only normal taxable slab, or partially used for personal exempted and partially for the normal sales. then in this case ITC, the concept of ITC will be applicable. Further, if any goods, any assets like building, car, of machine, furniture used for personal use only for exempted supply, so the concept of ITC will not be applicable. For instance, a car is used for the purpose of supplying alcoholic beverage. So, and if a business is claiming for just to get the benefit of ITC, in this case it is not allowed because it is a exempted zero rated GST. So, in case of a normal, only normal taxable sales, even included zero rated sales will be the concept of ITC will be applicable. And in case of a partially used for personal exempted and partially for normal sales, so it will be going to calculate proportionately, means the input tax credit will be going to calculate proportionately. So I hope that you are enjoying well, right? By way of getting the lecture, they will be what here. So at any point, if things is not clear, so you may get in touch with the presenter. Right? So moving ahead, right? We have another concept of the discussion of input services. So input service means any service used by the provider of output service for providing an output services. For example, telecommunicating services we see in everyday of our life, right? So customer is paid already. Customer are going to pay the tax on the services offered by various service providers. Take the examples of Reliance Jio. So the Reliance Jio company is providing telecommunicating services. The customer is what paying the taxes on the same services in order to get the benefit of the internet services. Where every month we have a particular pack, and that pack consists of the taxable amount. On that case, the customer is paid for particular pack rupees 189, 200, 209. So this consists of tax too, and that company Reliance you already pay input taxes, right, on that services. So input tax is the GST charge on the purchase of goods and services used in the business activities, which I have already told you. While the output is what, on the other hand, is the GST charge and collected on sales or supply of such goods or services. I just told you that final the burden of GST is laid is go on the soldier of customer, means the common people have to get the burden of tax at the time of acquisition or going purchase of goods, any kinds of goods, or which is not the part of the CGST Act 2017. So on that goods a customer are paying various types of taxes. For example, tax on mobile phone at 18%, now it has been reduced from 18 to 12%. So the customer have to pay 12% on the particular smartphone, which whatever the amount will be. So in this case, the meaning of output tax is on the tax charged and collected on the sales. So output tax, the GST is charged and collected on sales, is known as the output tax. So when the goods are ready to make it in open market, so goods, so on such goods, tax is collected from the consumer on sales or supply of goods and services is known as the output. So moving ahead in this direction, input tax and how it is work. It is the input duty relief scheme under GST to reimburse supplier with duty paid on input with goods, capital goods into services by providing credit on duties and taxes. Examples of taxes, yeah, ITC just right now we have put it in our previous example. By way of another examples, try to understand the concept of ITC once again, because this concept is very important. So a manufacturer paid taxes on output. Final produce is rupees 450. Tax paid on input purchase is rupees 3. So you can claim input tax credit of these 300 because we have already paid taxes at the time of the acquisition of that particular product. So 300 rupees you can claim. This is what input tax credit of 300. So you need to deposit only 150 as GST. Only one GST payable means not more than 150 because 300 rupees you have already paid on the acquisition of the products. I hope that things are clear. So this concept of IGST is governed, ITC is governed by IGST 2017, CGST Central Goods and Service Tax, IGST Integrated Goods and Service Tax 2017, and supplier of the final product is eligible, provider of the output is eligible in case of a capital goods, right? If it is used for personal ITC, the concept of ITC is not allowed. I have already talked about these. Similarly, duties and taxes eligible for central value added taxes. So IGST, CGST, central goods and service tax, state goods and services. So credit will be available only if input capital goods input services used in the factory used in providing taxable services. So what will be the basis of the tax credits? So input invoice or bill issued by the supplier of inputs capital goods will be the basis for the getting the credit of input tax credit system. So as told you that there are certain goods which are the exempted goods or services. So ITC, the most important objective of ICT is to avoid tax on tax. Means once a manufacturer, the business has already paid tax on the acquisition of the tax. So the objective of ITC is to avoid it. Means no need to pay cascading effect means tax on tax. So if the final product is exempted or output service is exempted, so no credit is allowed. Means if it is a taxable supply, ITC eligibility. If it is an exempted supply, so ITC is not allowed to claim. The next is what? ITC is available for goods or services which is used for personal use, exempted or supply which is used for specifically not available. So in this case, ITC will not be available for goods or services. In order to get the benefit of input tax credit, there are few conditions which is mandatory to fulfill. The first condition, assessee should be a registered person under the Goods and Service Tax Act 2017. Now you can raise the question, what do you mean by the registered person? Meaning thereby, in simple word, you can say the person whose business is registered under the Goods and Service Tax Act 2017, meaning thereby bearing that registered person having the GST IN number, Goods and Service Tax identification number. So in order to get the benefit of input tax credit, the assessee should be registered person. First condition. Second condition, input should be in course or furtherance of the business, right? And possession, the third condition, possession of tax invoice, debit note or this document evidence payment must be, right? Means the in order to get the benefits of input tax credit, to for the purpose of ITC, it is mandatory to kept all the record means debit note, credit note or tax invoice. And next, fourth condition, receipt of goods or services as the case may be, tax paid by the supplier to government through cash or through utilization of the credits. Return is filed by the recipient of goods or services, amount towards supply of goods and services, and the tax thereon to be paid to the supplier within 180 days from the date of the invoice. If it is exceed 180 days, so you can't claim the benefit of ITC. not eligible if depreciation on tax claim under income tax. You are not going to get the benefit of in ITC if depreciation has been claimed on the fixed assets under the Income Tax Act 1961 as per the laid down guidelines. So in this, if following all conditions, you can get means the business can get the benefit of input tax credits. The timeline for availing ITC due date of filing of return for the month of the September of the succeeding financial year or the date of the filing of annual return, whichever is earlier as per section 6 subsection 4 laid down is in order to get the benefit of the ITC into tax credits, the due date of filing of return for the month of September of the succeeding financial year or the date of the filing of annual return, whatever the early or between these two dates. So I hope that the concept of ITC is now clear. With the help of example, just try to understand further a case studies on these ITC. So Hercules Machinery delivered a machines to XYZ in January 2021 under the invoice number 49 dated 28 Jan 2021 for 4,15,000 plus GST and undertook the trial run and calibration of the machines as per the requirement of XYZ. The amount chargeable for the post-delivery activities was covered in the debit note raised in April 2018 for rupees 50,000 plus GST. So XYZ did not file its return till October 2021. So though the debit note was received in the next financial year, it relates to an invoice received in the financial year ending 31st March. What will be the date of taking ITCC in this case? How you going to how you, what will be the date of this? So remember that rule. It must be 180 days. If the crossing, so it will be not going to claim the benefit of ITC. So how the next important discussion is how ITC is calculated. So what I told you just right now, why we are making a lot of discussion a lecture on ITC, because in the GST mechanism, GST structure, ITC have a very long lasting history, and the concept of GST is not quick easily understandable because it required lot of understanding, lot of attention is required to get the benefit of ITC. Means at what time the supply of goods has been supplied, at what time the supply of services took place, on which date, on which time, from where, either it is an intrastate or interstate. That is why we are having lot of emphasis towards the input tax credit. So in formula way, in terms of numerically, means how the concept of input tax rate is calculated. First, tax on sales means output GST, goods and service tax, less whatever the purchases means tax on purchases, tax on various kinds of expenses, tax on various types of machines. So all are the part of the input GST, means ITC input tax credit. So GST payable or GST credit means the balance ITC. So if you remember well in of our previous example, what I have just right now discussed, that whatever the tax paid on the acquisition of the materials, on acquisition of the raw materials or input capital goods, it is going to subtract from the output tax, means output GST, because the main motive, the fundamental of these GST, the concept of these GST based on the foundation of that, it avoid the cascading effect which was not addressed before the introduction of Goods and Service Tax Act 2017. So by way of this formula, we can calculate the concept of ITC. Moving ahead in this direction, as I told you that RCM, which is very important a concept under the goods and service tax. So let's try to understand what is RCM and how it works. So in case of a RCM, the is a system where the recipient of the goods or services liable to pay GST instead of the supplier. In the normal course of actions, is supplier paid the GST to the government. It may be central government, it may be state government, as per the nature of the transaction. In the normal case, supplier supply goods to the recipient and the recipient make the payment with GST and the supplier deposit the GST with the government. It may be central government, it may be state government. It is the case of the normal charge mechanism on the levy of Goods and Service Tax Act. But in case of a RCM reverse charge mechanism, the supplier supply goods to the recipient and the recipient make the payment to the supplier without GST, and that GST going to pay to the government by the recipient of that goods. It is the case of the reverse charge mechanism. In normal course of action, the supplier paid the GST to the government. But in case of a reverse charge mechanism, the receiver paid the tax to the government. But in a normal, the receiver, the supplier paid. But in the RCM, the receiver paid GST, deposit the GST with government on the behalf of the supplier. So it is the case of the RCM reverse charge mechanism, which have a very important aspect under the goods and service tax. So it ensures tax compliance in unorganized sector and with unregistered supplier. In normal course of action, whatever the registered supplier is there, going to make the payment of GST to the government. But in case of an unorganized sector or unregistered supplier, the receiver going to make the payment of GST to the governments. So condition to apply reverse charge under section 9 subsection 4 of CGST. So the reverse charge provision will be applied if following conditions are satisfied. Condition number 1, there should be the supply of goods or services. To condition number 2, the supply of goods in respect of taxable goods or services. The supply must be by an unregistered person. The supply must be to a registered person. The supply must be an intra-state supply, as the compulsory registration is required for interstate supply. So these all are the various conditions which have been laid down under section 9 subsection 4 of Central Goods and Service Tax Act 2017. I hope that things are now clear. So here three very important concepts are given. First, the supply must be by an unregistered person, means the person is not registered under goods and service tax phenomenon, and that supply must be to the registered person, means having the subrecipient must having the registration under GST, and the supplier by an unregistered person to the registered person, and it is must be the case of intra-state supply, means the supply within the state, not interstate. The supply must be an intra-state supply and the compulsory registration and required for the interstate sales. So I hope that in respect of goods and service tax regarding ITC, regarding reverse charge mechanism, regarding the value of supply is now clear to you. The next very important topic that we're going to start, the how the payment of taxes work under the goods and service tax. So every registered person required to make the regular payments under the GST is required to make to compute his tax liability on a monthly basis by setting off the ITC against the outward liability, and the electronic liability register shows the total tax liability of a registered person at any point of time. So the details can be accessed on GST portal of a registered tax person. The first point so to keep in mind, first, amount of tax payable, interest and late fees. C. Amount of tax payable along with the interest on account of mismatch of credit basis. Fourth, any other amount payable by the taxable taxpayer or directed by the board on account. TDS, tax deduction at source, tax collection TCS, tax collection at source, and tax under reverse charge basis. And last, particular amount paid by the department against an interest. So the balance in the electronic tax liability registered, the sum of A, B, C, D, E, F, G, H. So it will be the procedure of the payment made under the goods and service tax, which required a continuous on a monthly basis after setting off input tax credits against the towards liabilities. So I hope that the concept of ITC is now clear to all of you. We had just have a quick recap on what we have discussed just right now. We had discussed the concept of the valuation of the goods and service under the GST and the CGST Act. Similar to that, we had also discussed the concept of input tax credit with the help of various cases, various examples. We had also discussed the concept of reverse charge mechanism as well as normal course of business. So in respect of these all, we had discussed all the very important aspect from the perspective of the CGST Act 2017, means as per the rules and regulations laid down under the CGST Act 2017. So I'm here now. The lecture is over, but the discussion is not yet over. It required lot of further study. So for any kinds of query, for any kinds of doubt, confusion, you're most welcome at any time for all kinds of confusion query. So you can contact us on the given numbers. So I hope that things are now clear. Moving ahead in this direction, so I would like to express my sincere gratitude to the audience for your patience listening, patience watching this video. Meanwhile, I can understand that some concept is not clear to you, but if not, it's required lot of further study, because the concept of goods and service tax is not it can't be understood in one day video, or it can be learned in one day lectures, like of 1 hour lecture. It's required continuous efforts, it's required continuous study, right? Because government, the Indian government, Ministry of Finance, frequently making lot of amendment from time to time in accordance with the circumstance, in accordance with the time, lot of modification, lot of other changes. So a lot of attention is required, lot of discussion is required to understand the concept of goods and service tax and its various important mechanisms. So thank you so much for watching this video. I'm also thankful for Indian University for providing me a golden opportunities to make a video on these. Thanks you for in Center for Distance and Online Learning, and thanks last and whole credit goes to the audience of the watching, those who are watching that video, for their patience listening. So meanwhile, if any concept is not clear to you, you can contact me on the given number. We will discuss necessary issues, necessary questions, necessary query over there. So thank you so much for watching this video. Uh, wishing you a very happy and good day. Thank you so much.